All right. Today is Tuesday, December 14th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight, and it will be special. Let's start with the background. Today we received the PPI, also known as the Producer Price Index, and the reading was the most stunning and the most shocking reading we have ever seen, the highest of all time, as wholesale prices jumped by 9.6% year over year. Even after stripping food and energy, the reading is the highest on record. We are now reaching 1970s style inflation in a terrifying speed. On top of that, today we got sentiment readings from small businesses. And as you can see, the line in blue shows the increase of wages by small businesses, and in white, planned price increases. And it is the highest reading on record, paving the way for higher inflation to come. Consumers are spending like crazy as they race to consume ahead of inflation, exhausting their stimulus savings, regular savings, and even dipping into racking up debt by using credit cards, as inflation has wiped out all wage gains. Many out there are celebrating wage inflation as a positive outcome from this crisis. The problem is inflation is rising at a higher rate than wages, and therefore, when all accounted for, wages actually went down. And this is morphing into a political crisis, as the president approval numbers are plummeting and dropping like a rock, with 69%. Once again, 69% of Americans disapproving of his handling of this inflation crisis. And with that out of the way, here it is. In focus tonight, how about a trip back to the 1970s and the lessons we need to learn? We start with a brief history of the Fed. Before the 1970s, Bill Martin was the head of the Fed. He's known as the longest-serving Fed chair in history. But before that, he was the commissioner of the stock exchange in the 1930s, making him the youngest person in history to lead such a position.
New York Stock Exchange starts an experiment in modernization. Rules are simplified, and a new, smaller board of governors welcomes the youngest chief the exchange has had, William McChesney Martin, Jr.
The most pressing need today is to start the flow of capital, which turns the wheels of industry. The New York Stock Exchange plays a vital part in this process. Our duty is plain. We must do everything in our power to provide as safe and as efficient a market for the nation's securities as can be devised. I am sure, gentlemen, that we will all pledge ourselves to give our utmost efforts to accomplish this purpose.
Under his tenure as a Fed chair, the money supply, which by now viewers of this channel know, is the true cause of inflation. The money supply under Martin surged higher to finance the Vietnam War. And as you can see, in black, the money supply growth, and in red, inflation. There is a lagging reaction, but the correlation is accurate and proven throughout hundreds of years. Excessive money printing leads to inflation. Martin prided himself as an inflation hawk. And by the late 60s, he started to take measures to curb inflation. And then came the 70s. We can't talk about the 70s without talking about these three men whose decisions shaped that era: Nixon, Ford, and Carter. But in reality, inflation has always been a monetary phenomenon, not a fiscal one. Thus, these men leading the Federal Reserve, the most powerful entity in the United States, far more powerful than the Pentagon or the CIA, these men controlled the destiny of the economy and inflation. When President Nixon took office, inflation was a problem, but certain monetary tightening policies were taking effect and denting the rise of this inflation. Nixon changed all of that.
The major purpose of our economic policy since we came into office a year ago has been to stop the inflation which had been going on for 5 years without doing it so quickly that it brought on a recession. Now, as a result, we are now in a position, the critical position, in which the decisions made in the next month or two will determine whether we win this battle.
To prevent inflation without recession, in a phrase, President Nixon's described what's likely to become the chief domestic issue in American politics in the coming year. Can the heat be taken out of the world's mightiest economy without plunging it into the worst depression for over a decade? At the beginning of this month, President Nixon presented Congress with a $200 billion budget, the biggest in American history. Despite its size, the budget is deflationary. Its aim is to curb rising prices without cutting back too drastically the general level of business.
Sounds familiar? Like Build Back Better will crush inflation, not cause it to rise? Well, this delusional approach of wanting your cake and eat it too is not new. Nixon wanted an economic boom to score political points, yet monetary tightening to curb inflation was standing in his way as consumers were feeling the pain of higher prices.
At the consumer level, America may not look much like an economy in distress, but in shops and supermarkets in the residential suburbs, inflation is now beginning to bite hard. In 1967, retail prices rose by 3%. In 1968, they went up 5%. Last year, the increase was over 7%, and figures for last month show the upward trend is still continuing. Over the last 3 years, most Americans were protected from the worst effects of inflation because their incomes were rising too. But with 4 years' momentum behind it, inflation's built severe distortions into the economy. To prevent these getting any worse, President Nixon and his advisors followed a deflationary policy for most of last year, and its effects on the commercial and industrial life of the nation are now clearly visible. On Wall Street, share prices fell steadily throughout 1969 until at the beginning of this month the market stood at its lowest level for 6 years.
Sounds familiar, right? Wages were rising until they fell behind inflation. Thus, monetary tightening took effect, and this caused the economy to slow down and cost the stock market severe losses.
Inflation means having more money in circulation than the country has really earned. But although you can't increase national wealth simply by printing more money, there is a relation between money supply and economic activity. America's money supply normally grows at the rate of 4% a year, but the Federal Reserve Bank, which controls such policy, has kept the growth to zero over the last 6 months. Some economists say that by doing so, by refusing to print more money, the bank is merely helping to create a recession. Everyone agrees that monetary restraint is an important weapon in the fight against inflation. But some economists believe it's already been taken too far.
And here it is, the birth of the biggest economic policy error in the 20th century. Nixon decided enough is enough, and he appointed his buddy, Arthur Burns, as Fed chair to bring back the printing machine. Print, baby, print.
I, Arthur F. Burns, do solemnly swear.
I, Arthur F. Burns, do solemnly swear.
That I will support and defend the Constitution of the United States.
I will support and defend the Constitution of the United States
against all enemies, foreign or domestic.
The man who's now got the job of controlling the nation's money supply is Dr. Arthur Burns, the new chairman of the Federal Reserve Board. He takes over at a time when the business community is looking forward to a relaxation of financial restrictions. He's a personal friend of President Nixon, who went to great lengths at Burns' inauguration to show his support.
You see, Dr. Burns, that's a standing vote of appreciation in advance for lower interest rates and more money.
Unfortunately, Nixon was not joking. His buddy Burns decided to bring back the loose monetary policy to benefit Nixon politically by allowing cheap lending to the rich and Wall Street, and instead shifted the tightening to the fiscal policy by placing austerity measures on average citizens.
I believe that some preliminary planning on stronger measures to reduce domestic consumption should be undertaken at once. These might include a sizable tax on gasoline, or on imported oil, or on automobiles according to their weight or horsepower. The policy that I have advocated this morning is a policy of austerity. I recognize that it must be carried out prudently, if possible, without intensifying the recessionary tendencies that are already developing in our economy.
Fed Chairman Burns was as delusional as the current Fed Chair Jerome Powell. He even used the word transitory to describe the revival of inflation, reading from the article. Yet Burns, who ruled the Fed with an iron fist, lacked an analytical framework to assess the interplay between the real economy and inflation, and how that relationship was connected to monetary policy. As a data junkie, he was prone to segment the problems he faced as a policymaker, especially the emergence of what would soon be and become the Great Inflation. Like business cycles, he believed price trends were heavily influenced by idiosyncratic or exogenous factors, noise, quote-unquote, that had nothing to do with the monetary policy. Sounds familiar? This was a blunder of epic proportions when oil prices quadrupled following the OPEC oil embargo in the aftermath of the 1973 Yom Kippur War. Burns argued that since this had nothing to do with the monetary policy, the Fed should exclude oil and energy-related products such as home heating oil and electricity from the Consumer Price Index, also known as the CPI. The staff protested, arguing that it made no sense to ignore such important items, especially because they had weighed over 11% in the CPI. Burns was adamant if we on the staff would not perform the calculation, he would have it done by someone in New York, quote-unquote, an allusion to his prior affiliation at Columbia University at the National Bureau of Economic Research, one of the most corrupt Fed chairmen in history. It was a fair point to a point. Unfortunately, Burns did not stop there. Over the next few years, he periodically uncovered similar idiosyncratic developments affecting the price of mobile homes, used cars, children's toys, even women's jewelry, the gold mania as he dubbed it. He also raised questions about home ownership costs, which accounted for another 16% of the CPI. Take them all out, he insisted. Then came surging food prices, which Burns surmised in 1973 were traceable to unusual weather, specifically El Niño event that had decimated Peruvian anchovies in 1972. He insisted that this was the source of rising fertilizer and feedstock prices, in turn driving up beef, poultry, and pork prices. This guy makes Jerome Powell sound like an angel. Like good soldiers, we gulped and followed his order to take food which had a weight of 25% out of the CPI. This is according to the Fed staff. We did not know it at the time, but we had just created the first version of what is now fondly known as the core inflation rate, the purified portion of the CPI that purportedly is free of the volatile quote-unquote special factors of food and energy. How about stripping out oxygen too? Where gyrations were traceable to distant wars and weather. Burns was pleased monetary policy needed to focus on more stable underlying inflation trends, he argued, and we had provided him with the perfect tool to sharpen his focus. This is the mistake, folks. The denial, the remedy that was taken back then is manipulating the data. By the time Burns was done, only about 35% of the CPI was left, and it was rising at a double-digit rate. Only at that point, in 1975, did Burns concede, far too late, that the United States had an inflation problem. The painful lesson: ignore so-called transitory factors at great peril. Fast forward to today, evoking an eerie sense of déjà vu, the Fed is insisting that recent increases in the price of food, construction materials, used cars, personal health products, gasoline, car rentals, and appliances reflect transitory factors that will quickly fade with the post-pandemic normalization. Scattered labor shortages and surging home prices are supposedly also transitory. Sounds familiar? There are many more lessons from the 1970s that shed light on today's cavalier dismissal of inflation risk. And back to the 1970s. The truth is, the Arab oil embargo, which many blamed during that era for the rise of inflation, that embargo only lasted from 1973 to 74. Yet, as you can see, oil prices remained high even after the embargo was over, because the original source of inflation, the loose monetary policy, the loose money policy by the Fed, was still going. Many remember or heard of the massive lines for gas during that era, with consumers paying high prices and facing severe shortages in gas. Inflation became a political headache for Nixon, so he decided to be more aggressive with austerity measures, this time by freezing wages.
The second indispensable element of the new prosperity is to stop the rise in the cost of living. One of the cruelest legacies of the artificial prosperity produced by war is inflation. Inflation robs every American, every one of you. The 20 million who are retired and living on fixed incomes, they are particularly hard hit. Homemakers find it harder than ever to balance the family budget. And 80 million American wage earners have been on a treadmill. For example, in the 4 war years between 1965 and 1969, your wage increases were completely eaten up by price increases. Your paychecks were higher, but you were no better off. We have made progress against the rise in the cost of living. From the high point of 6% a year in 1969, the rise in consumer prices has been cut to 4% in the first half of 1971. But just as is the case in our fight against unemployment, we can and we must do better than that. The time has come for decisive action, action that will break the vicious circle of spiraling prices and costs. I am today ordering a freeze on all prices and wages throughout the United States for a period of 90 days. In addition, I call upon corporations to extend the wage price freeze to all dividends. I have today appointed a cost of living council within the government. I have directed this council to work with leaders of labor and business to set up the proper mechanism for achieving continued price and wage stability after the 90-day freeze is over. Let me emphasize two characteristics of this action. First, it is temporary. To put the strong, vigorous American economy into a permanent straitjacket would lock in unfairness. It would stifle the expansion of our free enterprise system. And second, while the wage price freeze will be backed by government sanctions, if necessary, it will not be accompanied by the establishment of a huge price control bureaucracy. I am relying on the voluntary cooperation of all Americans, each one of you, workers, employers, consumers, to make this freeze work. Working together, we will break the back of inflation, and we will do it without the mandatory wage and price controls that crush economic and personal freedom.
Nixon, of course, did not keep his promise and implemented harsh austerity measures and price-controlled policies which succeeded to slow down inflation, but this came at the price of unemployment.
In terms of people, some 920,000 Californians are now out of work. Locally, the unemployment rate has risen to 8.9% in the Los Angeles-Long Beach area, and in the lines today, few people were expressing any optimism about quick economic recovery.
Automotive assembler, and I've worked for General Motors for 5 years, and I've been unemployed since the 8th of November.
I'm a waitress. How long have I been out of work? Since June the 20th of 73.
What do you think about the president's proposals for uplifting the economy? You feel that they're going to help people like yourself get back to work quickly?
No, not quickly. Not at all. It's going to take a long time because it took a long time to get where we were now. I just hope that they can get together and put their heads together and find out something that'll help me get back to work.
Of course, this lady was born in the wrong era. Had it been today, she would have done OnlyFans and would have not needed to find a job. But all joking aside, that slowdown in inflation only lasted for a while before inflation came back with extreme ferocity. In the end, Nixon failed to control inflation, and he resigned due to other political problems that I'm sure you're familiar with. Inflation defeated Nixon, and America decided to push forward into the battlefield to become the next president who will lead the fight against inflation.
The tyranny of double-digit inflation is our common enemy in 1974. I think everybody in this wonderful audience tonight knows as well as I do that inflation is the cruelest kind of taxation without representation.
My conclusions are very simply stated. There is only one point on which all advisors have agreed. We must whip inflation right now. we do have a real energy problem. 1/3 of our oil, 17% of America's total energy, now comes from foreign sources that we cannot control at high cartel prices, costing you and me $16 billion, $16 billion more than just a year ago. The primary solution has to be at home. If you've forgotten the shortages of last winter, most Americans have not. I have ordered today the reorganization of our national energy effort and the creation of a National Energy Board. It will be chaired with developing, or I should say charged with developing a single national energy policy and program.
Despite his best efforts to scale up domestic oil production to curb the rise of inflation, Ford failed. So he decided to follow the same mistake Nixon initiated by urging Americans to impose self-austerity measures in an effort known as Whip Inflation Now, or WIN. Citizens were encouraged to wear pins reading WIN to participate in that effort.
I will not take your time today with the discussion of the origins of inflation and its bad effect on the United States. But I do know where we want to be in 1976, on the 200th birthday of a United States of America that has not lost its way, nor its will, nor its sense of national purpose. During the meetings on inflation, I listened carefully to many valuable suggestions. Since the summit, I have evaluated literally hundreds of ideas, day and night. My conclusions are very simply stated. There is only one point on which all advisors have agreed. We must whip inflation right now. Unless every able American pitches in, Congress and I cannot do the job. Winning our fight against inflation and waste involves total mobilization of America's greatest resources, the brains, the skills, and the willpower of the American people. Here is what we must do, what each and every one of you can do to help increase food and lower prices, grow more and waste less, to help save scarce fuel in the energy crisis, drive less, heat less. Every housewife knows almost exactly how much she spent for food last week. If you can't spare a penny from your food budget, and I know there are many, surely you can cut the food that you waste by 5%. Every American motorist knows exactly how many miles he or she drives to work or to school every day, and about how much mileage she or he runs up each year. If we all drive at least 5% fewer miles, we can save, almost unbelievably, 250,000 barrels of foreign oil per day. By the end of 1975, most of us can do better than 5% by carpooling, taking the bus, riding bikes, or just plain walking. We can save enough gas by self-discipline to meet our 1 million barrels per day goal. There will be no big federal bureaucracy set up for this crash program. Through the courtesy of such volunteers from the communication and media fields, a very simple enlistment form will appear in many of tomorrow's newspapers along with a symbol of this new mobilization, which I'm wearing on my lapel. It bears the single word "win." I think that tells it all. I will call upon every American to join in this massive mobilization and stick with it until we do win as a nation and as a people.
Inflation did indeed respond to whip inflation now. However, it did not take long before inflation came back stronger and more vicious than before. This cost Ford politically, and he lost the elections to the newest victim America was about to throw in the ring to fight the inflation monster, President Jimmy Carter. Carter, to fight inflation, immediately initiated more austerity measures.
The government has been spending too great a portion of what our nation produces. During my campaign, I promised to cut the government share of our total national spending from 23%, which it was then, to 21% in fiscal year 1981. We now plan to meet that goal 1 year earlier. Reducing the deficit will require difficult and unpleasant decisions. We must face a time of national austerity. Hard choices are necessary if we want to avoid consequences that are even worse. I intend to make those hard choices. I have already vetoed bills that would undermine our fight against inflation, and the Congress has sustained those vetoes. I know that the Congress will continue to cooperate in the effort to meet our needs in responsible, non-inflationary ways. I will use the administrative and the budgetary powers of my office, including the veto if necessary, to keep our nation firmly on the path of fiscal restraint. Restraint involves tax policy as well as spending decisions. Tax reduction has never been more politically popular than it is today. But if future tax cuts are made rashly, with no eye on the budget deficits, they will hurt us all by causing more inflation. There are tax cuts which could directly lower costs and prices and help in the fight against inflation. I may consider ways to reduce those particular taxes while still cutting the budget deficit. But until we have a convincing prospect of controlling inflation, I will oppose any further reductions in federal income taxes. To keep the government to a manageable size, I'm ordering tonight a cut in federal hiring. This order will mean a reduction of more than 20,000 in the number of permanent federal employees already budgeted for this fiscal year, and will cut the total size of the federal workforce. I've already placed a 5.5% cap on the pay increase for federal employees, and federal executive officers are receiving no pay increases at all. It's not enough just to control government deficits, spending, and hiring. We must also control the costs of government regulations. In recent years, Congress has passed a number of landmark statutes to improve social and environmental conditions. We must and we will continue progress toward protecting the health and safety of the American people. But we must also realize that everything has a price and that consumers eventually pick up the tab. Where regulations are essential, they must be efficient. Where they fight inflation, they should be encouraged. Where they are unnecessary, they should be removed.
Despite his best effort, inflation surged and started to cost Carter politically. Americans became extremely frustrated with the inflation crisis, morphing into a lethal stagflation phenomenon.
In 1 year, the American economy had spun out of control. Gasoline prices had more than doubled. Mortgage rates pushed 20%. Unemployment kept on rising. Of all the problems facing the nation, most Americans now agreed inflation was the most urgent. In the summer of '79, fueled by rising oil prices, it surged to 14%.
Then came the savior, legendary Fed Chairman Paul Volcker, who dared to take the initiative no one wanted to take before, tightening the monetary policy aggressively. By doing so, Volcker sacrificed Carter's political career, and perhaps his own, as massive resistance from Wall Street and corporate insiders faced Volcker.
When I was appointed by Jimmy Carter, he was kind of up against it. It was a very difficult period. I told them we were going to have to adopt tighter policies, and I felt very strongly about the independence of the Federal Reserve, and that's the way I thought we should act.
Burns said in a speech after he left the office, we knew, meaning we central bankers, that we had to reduce money growth back in 1964 or we were going to have inflation. And he lists all the reasons why he couldn't do it. It was that meeting that Paul Volcker left to do what Burns said couldn't be done.
People don't like to raise interest rates. It's not very popular. And there was some resistance and fear of creating a recession and so forth.
It was a close thing for Volcker even to pull it off internally. He had a substantial battle within the Federal Reserve.
Volcker had tried to get the Fed governors to nudge interest rates upward, without success. So he tried a different tack, persuading them to focus on controlling the money supply. It was a sleight of hand, because the two are essentially the same. But it was a politically palatable tactic, and it worked.
And when he slowed the money growth rate, predictably, the interest rate went way up.
Neither he nor I nor anyone else had any idea of how high the interest rate was going to be.
8% to 9% to 10%.
15% to 18, 19, 20%.
21%. Really the highest levels in American history.
He told me, I never thought we'd have to go to 20%. But he did. That took courage.
Paul Volcker was villainized for his inflation suppression.
At the end, inflation lost the battle, not against Nixon, Ford, or Carter, but against the giant Fed chairman, Paul Volcker, who stood tall and strong to do the right thing for the nation and the economy, even if it meant dipping into a recession to restart the economic cycle again. After Volcker came Greenspan, who unfortunately enabled more monetary lunacy. Likewise, after him, Ben Bernanke. All of these Fed officials led the economy into cycles of boom and bust that benefited the rich and Wall Street while crushed the poor and the middle class. Then came Janet Yellen, who started to sober the Fed policy by increasing rates higher. Wall Street insiders lobbied President Trump to axe Yellen and replaced her with Jerome Powell, who stands reflecting a clear and eerie resemblance of Arthur Burns, the worst Fed chairman in history. But will Jerome Powell channel his inner Volcker in tomorrow's meeting and the press conference? We will revisit this question at the end of the video. Anyhow, folks, that concludes the history lesson. And the take is, the remedy for higher inflation, out-of-whack inflation, is not the fiscal policy. It is not austerity measures. It is not price wars. It is not price controls. It is not blaming boogeymen overseas for oil prices. None of that will work. The only proven remedy to control inflation is tightening the monetary policy, tightening the loose money policy, cutting the amount of cocaine the Federal Reserve is injecting into the stock market and the economy every single month, normalizing interest rates. Real interest rates right now at below zero. We have negative real interest rates in this economy. Why? All of this is done by design to benefit the stock market, to benefit corporations and the rich. And now all of a sudden the Fed is scrambling and panicking about this out-of-whack inflation. Anyhow, folks, we have to move on here and cover the market information, starting with the performance. And here we go! The Dow Industrial Average closed in the red, down 106.77 points, or a decline of 0.30%. The Nasdaq closing in the red, down by 175.64 points, or a decline of 1.14%. The S&P 500 also down by 34.88 points, or a decline of 0.75%. And what about the sector's performance today? Leading the pack at number one and not getting any medals because the performance overall is pathetic. But number one, financials, the only sector of the market closing in the green today. And the reason is in anticipation of the Fed tightening the monetary policy and perhaps raising interest rates. The problem is I cannot guarantee that the yields on the 10-year will actually move higher. They could crash as the bond market signal a recession. But this is the bet for now from the market, betting that financials will move higher as a reaction of the 10-year yield also moving higher. The laggards of the day led by technology, real estate, and industrials. What about the advance to decline ratios for the market today? NYSE 28% advancing versus 70% declining. The Nasdaq 27% advancing versus 69% declining. Look at the breadth Absolutely awful. 304 new 52-week low versus only 11 new 52-week highs in the NASDAQ. Moving on to futures, what's going on here? Crude oil prices are down by about 1.5% apiece for both the WTI and Brent. Likewise, gasoline down, heating oil down, while natural gas prices pretty much on the flat line. What about softs? OJ's blasting higher. We covered the chart of OJ. We had a trade due to the reverse head and shoulder formation. And here it is, OJ futures gaining over 4.5% today. And perhaps there is more juice to squeeze in this rally for OJ, no pun intended. Meanwhile, we have coffee and sugar pretty much in the flat line, while we have a modest retreat for lumber futures, which been rallying aggressively as of late. And then we have declines, less than a percentage, for both cocoa and cotton futures. What about metals? They're all declining. Gold down, silver down, platinum down, copper down, palladium down big, and palladium continues to get crushed here. Metals are waiting for what? Waiting for Powell and the reaction of the US dollar after the FOMC meeting. What about meats? What do we have here? Declines across the board, be it modest declines. Live cattle down, feeder cattle down, lean hogs down, no exception here. What about grains? We have pops for soybean meal, soybeans, corn, and oats futures, all gaining today, and soybean meal gaining over 4% today alone. While we have declines led by soybean oil. Soybean oil lost over 2% today, while we have modest declines for wheat, rough rice, and canola futures. Moving on to the big casino, the options market. What's going on here? Leading the pack at number 1, per usual. The hottest table is Apple, with a little over 2 million contracts traded today. About 65% of those were calls. The call options buying in Apple remains intense and aggressive, with no rationale whatsoever. And here it is at number 2, Tesla, the souffle, with a little over 700,000 contracts. About 50% of those were calls. And at number 3, AMC, a surge in volume here, almost 600,000 contracts. About 54% of those were calls. And what about the unusual activities that took place in the options market today, starting with the ticker AMC? The apes are performing a rescue operation here by buying the 26 calls for the expiration date this upcoming Friday, December 17th, with the expectations that AMC could pop higher and gain over 6% by the end of the week, and they paid about $1 apiece to enter this trade. All in all, spending about $1.5 million. But we also saw aggressive put options buying, so it's a battle here. The bears, the shorts, are smelling blood, and they are striking. Will the apes succeed in defending the jungle? Who knows? But here it is. What about the trades for the ticker JETS, Jets? This is the airlines ETF. I am short airlines via American Airlines, the weakest link here, but this is not a good looking chart, folks, and I will cover it during the chart analysis. But here it is. My interpretation here is somebody who holds the ETF Jets, they sold upside calls with a shorter expiration date to buy puts for a longer expiration date. In this case, they sold the 22 calls for the expiration date January 7th, and they used some of that money to buy the 18 puts for the expiration date January 14th. They received about 25 cents apiece from selling the calls, and they paid about 35 cents apiece to buy the puts. All in all, spending about 10 cents apiece, spending about $150,000 for this trade. What about the ticker CVNA for Carvana? They're buying the dip here via calls. They bought the 260 calls for the expiration date December 17th, meaning this upcoming Friday, with the expectations that CVNA could pop higher by more than 8% by then. They paid about $1 apiece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker EDR for Endeavor Holdings? Interesting trade here by buying the 35 calls for the expiration date February 18th. With the expectations that the name could pop higher by more than 16.5% by then. They paid about $1 apiece to enter this trade. All in all, spending about $1 million. What about the trade for the ticker QQQ for the NASDAQ? They're buying puts here, the 365 puts for the expiration date December 23rd, with the expectations that the Qs could go down by more than 6% by then. They paid about $1 apiece to enter this trade. All in all, spending about $600,000. And lastly, at the bottom of the table, what about the ticker EVBG? This is for Everbridge. The name is down big. Year to date, it is down over 50%, but somebody's buying the dip here, betting on short covering, also known as profit taking for the shorts. They're buying these $70 calls for the expiration date December 17th, with the expectations that the name could pop higher by more than 5.5% by then, with almost 3 days till expiration. They paid about $1.80 a piece to enter this trade. All in all, spending about $1 million. Moving on to the heat map analysis, what's going on here? The obvious is an exodus from high-risk, high-multiple stocks, specifically in the technology software segment. When you see names, even the big caps, the giant caps, the likes of Microsoft down over 3% today, the market is sending a message here of extreme de-risking before the Fed's meeting and the conference from Jerome Powell. The interesting take here is, notice the performance of utilities and REITs. They're down. Meanwhile, banks, financials were the winners today, trading higher. The message from the market is rates will move higher after the meeting tomorrow, specifically on the 10-year yield. The mystery is, will yields move higher because Powell is too hawkish and he will indeed increase interest rates higher? Or will rates move higher in anticipation of growth because Powell is dovish and is backing off from jacking interest rates higher? Interesting. I cannot answer this question.
I'm not that clever.
We have to wait till tomorrow. But for now, I'm moving on to the charts analysis, starting with SPY, 30 minutes chart. What's going on here? Obviously, the bears gained significant advantage here because the SPY lost the support of 466. It caught support from 461. The problem is, you want to head into a Fed meeting with the market being oversold because the risk becomes to the upside, not the downside. The end of the day rally canceled all of that, meaning the market is no longer oversold. When you look at the RSI from a 30 minutes perspective, it was oversold, but the last minute short covering and pumping is not good for the bulls because again, you want to head into the Fed meeting with the lowest and most dire expectations out there. So whatever he says, it becomes better than expectations and the market pops higher. But this pop at the end of the day canceled all of that. For now, the bears have gained significant advantage of this chart and the bulls lost control. Let's see if Papa Jerome can flip that picture tomorrow or not. But here's a daily chart for the continuous contract for the SPY, the S&P 500. What's going on here? The obvious is we have 2 days in a row here with higher than average volume to the downside. On top of that, the RSI indicator is curling down. The MACD indicator is also curling down, threatening to cross the negative territory once again. This will not be good for the bulls, and it will be welcome news for the bears. Add more pain to the misery. The bulls lost 4,657 for support. So right now, it's a battle, but the advantage is to the bears. The bears are the favorites here, unless Jerome Powell does something tomorrow. What about the NASDAQ 30 minutes chart? What's going on here? We knew ahead of time that this chart is a lot weaker than the SPY because it lost the support of 397, and therefore the losses in the Qs are amplified compared to the SPY. The chart lost the support zone, but it did indeed close the gap and then it curled its way higher, canceling the oversold reading on the RSI. This is bad, folks, for the bulls. If the market closed at the lows of the day with oversold readings, all what Powell has to do is be slightly dovish by saying, you know what, we'll keep an open mind when it comes to interest rates. Yes, we have a framework to raise interest rates higher next year, but we will be adaptive in case the economy slows down. Boom. The market would have blasted higher. But now we don't have that oversold reading anymore. What about the daily chart for the continuous contract in the NASDAQ? What's going on here? We take a look and ooh, what a beating. Not a good looking chart here, erasing all of the gains from the pump from last week. And therefore, we said it's going to be a bull trap. And indeed, it is a bull trap, at least for now. When you look at it, the support of 15,976 is lost now. We have yet another day of selling on higher than average volume. That's check mark number 2 for the bears. Check mark number 3 is the fact that the MACD indicator failed to cross the positive territory, and it is curling down once again. So is the RSI. So once again, the bears are gaining advantage here in this chart. What about the Russell 2000, the IWM? What's going on here from a 30 minutes perspective? Not looking good. Yes, oversold. All in all, but you lost the support of 218, and now we're looking at 213.80, and this is the last support. After that, if we zoom out to the weekly chart, you're gonna break the consolidation range that has been going on since the beginning of the year to that downside in the Russell 2000. What does that mean? All of that energy will be released right away in a massive flush down and a breakdown from the consolidation range. Watch 213.80 like a hawk. Once again, no pun intended. And here's the chart for the Dixie, the dollar index. What's going on here for Tricky Dixie? One of the most important charts to watch in reaction of the FOMC meeting tomorrow. My hunch is, and I could be wrong here, but I'm just going to lay it out there. If the Fed comes out too hawkish, tapering all asset purchasing programs, and perhaps setting the framework for raising interest rates higher, Powell doesn't need to say that. The dot plot will say it. If that happens, the rational reaction is the dollar should pop higher because you're tightening, you're not weakening the currency. You're not printing like crazy. You're ending the loose money policy, and therefore the dollar should pop higher. But I have a hunch that we will see sell the news here, meaning the dollar was rallying higher in anticipation of this hawkish stance, and now that we have it, the dollar flushes down. And if that happens, keyword if, this will be good for gold, even though gold has a bear flag. Yet if it continues to hold on above 1,763 and the dollar flushes down, I believe that gold will pop higher. Here's the second enemy for gold, the chart of the 10-year yield, moving a little higher today, and everybody assumes, including me by the way, that when the Fed ends the purchasing programs for bonds, then who's going to replace the Fed's purchasing power? Japan? Japan cannot do that. Individual investors, they can't do that. So what happens when the sugar daddy stops buying bonds? Yields spike higher. This is the rational reaction, but what we've been seeing as of late is the bond market throws a fit every time Powell comes out hawkish, meaning they rush into buying bonds, pushing prices higher and yields down, and thus flattening the yield curve. As if they're warning Powell, if you tighten right now, you're gonna push the economy into a recession. But as great economist David Rosenberg said in a tweet today, perhaps recession is the remedy that we need to curb this inflation. Pay attention now. Perhaps this is what we need to curb inflation, aka the Volcker approach. In Volcker's case, yields spiked higher. But unlike the 70s, what we've been seeing so far in this inflation, gold is not rising higher, yields are not rising higher, the dollar is not getting crushed down, and all of that due to the Fed's quantitative easing and the so-called accommodative policy, which distorted everything, and that accommodative policy was not there in the 1970s. The important threshold here is 1.5. If the 10-year yield climbs back, regaining 1.5 for support, then you know for sure yields will move higher. However, if the chart flushes down below 1.375, then you'll know for sure yields are going down and we are heading into a recession, and the TLT will pop higher. Here was a chart for the TLT, a weekly chart, regaining 149 as support once again. We'll see what happens here, but these are two charts along with the dollar and gold that you want to watch carefully. Here is a 4-hour chart for the VIX. What's going on here? Gaining the higher low, regaining 20 as support. We have crossing, a positive crossing, creating green impressions in the histogram of the MACD. All of these are check marks for market bears, betting that the VIX will pop higher. And if the VIX pops higher, it's not going to be good for the SPY. And here's a daily chart for Apple. What's going on here? Performing a little better than Microsoft and the rest of mega cap stocks. And this is done via aggressive call options buying. And we have yet another one as Bank of America upgrades Apple, the latest in a slew of upgrades from corporate America and Wall Street. The problem is, if Powell comes out too hawkish, you cannot defend the valuation of Apple anymore. We might see the capitulation here from the bulls, the manipulators, whatever you want to call them. Once they bail out, Apple will suffer losses like we've seen today in Microsoft stock. They're all betting that Papa Jerome will save them. We'll see if that happens or not. But here's the chart of Tesla, the Souffle daily chart. What's going on here? Still trading below 1,000. And yes, Reverend Elon made another pump for Doge. It did not help Tesla stock, but we saw aggressive call options buying here for the 1,000. Tesla bulls want to climb back 1,000 by the end of the week. The bears, on the other hand, took profits on the 950 puts. Interesting. The bears are still weak. The bears are still traumatized. And therefore, we're not seeing that massive flush down that we've been waiting for. It could happen after Jerome Powell cements the fact that the Fed will be hawkish, and then a high multiple stock like Tesla will get crushed. What about tulips? BTC, what's going on here? The momentum indicators appear to be bottoming. But here's the problem. You cannot trust any of that, because if Powell comes out too hawkish, then the market will shift to a risk-off mode. And we know that BTC, cryptos in general, are risk-on. When we switch the risk off, you're going to liquidate your Bitcoin holdings and perhaps jump into bonds, consumer staples, something more safe here. So we have to wait till the aftermath of the FOMC meeting. And here it is. What about AMC? The apes are fighting back here, buying a lot of calls. They're trying, of course. Could they close the name above 26 by the end of the week? If they do, then this will be a massive victory for the apes. The problem is, what I'm seeing in the options market is we have a lot of shorts, a lot of bears seizing this opportunity by buying puts, threatening the reverse gamma squeeze phenomenon. I say the best bet here for the apes is Papa Jerome Powell. If he comes out a little dovish tomorrow, enabling the risk-on mode once again, you'll see AMC popping higher aggressively. But absent of that, it's a long shot. And lastly, what about the chart of the ticker JETS, Jets? This is the airlines ETF, a weekly chart. What's going on here? I don't like it because it is forming a head and shoulder formation, and perhaps the destination will be closing the gap you can see clearly on the chart. So we're avoiding airlines for now. Let's see what happens after closing the gap, because we have another gap below that. You combine the thing, the Pokemon variant, with an aggressive Fed that's about to raise interest rates higher, and you have all of these airline companies heavily indebted. What do you think going to happen? Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? In case you were asleep throughout this video, we have retail sales, then we have the import price index, the Empire State Manufacturing Index, the Home Builders Index. But the most important event is the FOMC announcement, the press conference that will follow up by Papa Jerome Powell. All eyes. This is like Super Bowl for us involved in financial markets and those of us observing the economy. The most important FOMC announcement perhaps in history. Get out the popcorn, get out the diapers, get out everything, because you might need all of that. And before I end the show, here is the top concerns for the market right now. Number one is tapering and policy mistake. What does that mean? The Fed being too hawkish. Again, I say, what other option does the Fed have here? Nothing. Either you're going to face stagflation or hyperinflation. This is becoming a massive problem, politically speaking, and therefore the Fed has no other choice but to tighten and taper. And if that leads to a market crash and a recession, so be it. When you think about it, even Jack Dorsey is tweeting transitory today after the PPI reading. You think Jerome Powell and the Fed are not looking at this? That even non-market observers are now commenting on the inflation phenomenon, mocking the Fed. He has to respond back, and he will respond back by being aggressive in tapering and raising interest rates higher. The problem is, even if that happens, it might not curb inflation, and Jerome Powell might need to be even more aggressive. That is the risk. It's not tapering. We already priced that in. It's not even interest rates hikes, the modest ones, perhaps 2 or 3 coming out next year. It is the unknown. And the unknown for now is inflation spiraling out of control, getting even larger than it is right now, and the Fed having to become even more hawkish, slamming their foot on the brakes and crashing this economy, crashing the market, and dipping us perhaps into a massive recession. Unfortunately, this is the result of the financial engineering, the reckless monetary policy by the Fed for years now. But we've been talking about this subject ad nauseum in this channel. And therefore, this is all I got for you for now, folks. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.